Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, December 6th, 2023. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So, number one, the October jobs report, November ISM services PMI, ADP employment report, and revisions to the Q3 non farm productivity and unit labor cost data were each supportive of the consensus soft landing expectation, reducing the probability we exit the current positive correlation, positive absolute return regime for both stocks and bonds in the near term. All told, we define soft landing as a period in which below trend but positive economic growth allows the labor market to deteriorate in a way that perpetuates disinflation, but does not contribute to a broad based decline in household income and consumption. While that outcome is the consensus expectation among both buy side and sell side market participants, the current Goldilocks top down market regime is likely to be sustained as long as economic data continue support maintaining that belief. And lastly, number three, remember your ability to make and save money in financial markets has nothing to do with whether the US economy has soft, hard, or no lands. It has everything to do with your ability to avoid pigeonholing yourself into one of those three camps. Asset markets reserve the right to price in all three scenarios in any order they choose. It's our job to help you react to such pivots quickly enough to maximize upside capture in bull markets and minimize downside capture in bear markets. If you wish for us to predict precisely when such pivots will occur, you will be sorely disappointed joining the ranks of the average professional and retail investor whose predictions have not made them any money for 2 consecutive years. Stop losing money because of faulty macro predictions and start making money because of proper macro risk management instead. Transitioning to my 42 macro dashboard here, we have a couple of oversold or a few oversold signals in the commodity space this morning. Crude oil, this is Brent crude oil. It's nearing the lower boundary of its trading range provided from our friends over at Longbow. We have DBB, that's base metals, are also at the lower boundary of their respective trading range, as well as DBC, which is the broad commodity basket that's at the lower boundary of its trading range as well. So, definitely commodities is an asset class that should work in absolute return terms in a Goldilocks regime. It is not currently working as indicated by our volatility, just a momentum signal, which has kept investors on the right side of the risk in the commodity space. So, definitely not necessarily a buying opportunity until we see more positive developments in the volatility, just a momentum signal provided for those particular instruments. But certainly, if you've been short those things, this will be a good spot to think about tactically reducing some risk on the short side in those exposures. And then lastly, transitioning to our 42 macro aware community, we got a great question this yesterday. Somewhat of a novice question, but they're an important answer as well because we have investors across all levels of sophistication in terms of our community here. So we want to make sure that obviously our researchers tends to be primarily focused on the institutional investor. We obviously help retail investors come up that learning curve and help them make and save money in financial markets as well. So again, we need to be spending time, helping investors across the entire sophistication spectrum really derive value from our research. So this was somewhat of a novice question, but I think it's important to answer for those of you who may be new to 42 macro. It says, does the recent tumbling of the Fed's reverse repo facility affect overall market liquidity, if at all? And as if this continues, how does this impact equity prices in the current Goldilocks environment? So the answer is yes. A decline in the reverse repo facility balance on the Fed's balance sheet moves money around the financial system in a way that makes it easier for market participants to obtain leverage. To speculate in assets, of various varieties. The opposite is true when the RRP is rising in value. So money is moving around the financial system in a way that makes it harder for market participants to obtain leverage. And obviously at the, any environment where it's easier to obtain leverage, you tend to see rising prices in asset markets. And so much that in an environment where it's more difficult at the margins to obtain leverage, you tend to see falling, if not consolidating asset prices at the margins. What we found in our work in terms of developing the now popular net liquidity model that everyone on Global Wall Street sort of seems to anchor on, which is the Fed balance sheet minus the Treasury General Account balance and the reverse repo facility balance. understanding that both of those balances, when they're rising, suck money. So not, they don't really suck money out of the financial system. They just move it around in a way that, again, is onerous from the perspective of asset market pricing. And so when that global liquidity, or so that net liquidity model, again, Fed balance sheet minus the RP minus the TGA, that model is reasonably correlated and co-integrated with asset prices. But what we found in our further study is that our global liquidity proxy is actually a much better indicator of market prices, as much higher co-integration and coefficient statistics in terms of explaining market, sort of levels in the market, changes in the market, et cetera. Right now, both our net liquidity model in terms of the U.S. liquidity and our global liquidity proxy, which is the aggregated sum of the global central bank balance sheets, global broad money supply, and global FX reserves minus gold. Both of those indicators are trending higher, as indicated by our macro weather model. The net liquidity model, the net liquidity instrument, it inflected to a positive trend in late October. The global liquidity proxy inflected to a positive trend in mid-November, and both of those obviously continue to be quite supportive. The deltas, the regimes that those indicators are in, continue to be quite supportive for the forward outlook for stocks, bonds, and Bitcoin, as indicated again by our weather model. So definitely check out our today's leadoff morning note or any of our recent research to kind of unpack that in greater detail. So we'll wrap it up there. Darius Dale presenting our macro minute for Wednesday, December 6th, 2023. Best of luck out there today. We'll catch you back here tomorrow. Cheers.